my talk is titled The Secret to Outperformance. I'm going to give you the secret in all of it. Well, it says finding a system that works for you. But I think this is one of the things that many people who are in your positions today, thinking about what they want to do after school, one of the questions that are or should be crossing your minds around this time. So a little bit about what I do. I am the founder and managing partner at Mayat Capital, and we invest in global securities markets, mostly on the equity side, and we consider ourselves value investors. And I've been doing this professionally for the past 15 years, or 15th year now. Most of our investments are in developed markets, like I said, and mostly in equities. And I'll talk a little bit about our strategy later in the presentation. But I think one of the things that we focus a lot on is always trying to think of issues like cognitive and behavioral biases, issues that come to the core of what I think is the underlying reasons why a strategy, in our case value investing, works. This is a very interesting quote from this martial arts master. He says, if you have to compare martial arts, then compare them as a mountain to a river. And then he says, the mountain should not look down on the river because it's slowly, and the river should not make fun of the mountain because it can't dance and move. Martial arts should be compared in terms of what they do offer instead of in terms of what they do not. And I think this is a very interesting analogy to investment strategies. And the reason I think this is a very good analogy is we have cases across time in many countries. We've got 3 up here of very different yet very successful investment strategies. And I think one of the mistakes that many people in my position make when they come and speak to you here is try to convince them that their strategy is the right one or the one that you should pursue. And instead, what I'm going to try and tell you today is not to just follow this person or that person, but try to find the one that really works for you. And I really think the key, or at least the thing that is least appreciated in picking an investment strategy, is that personal aspect. And I'm going to address it in a little bit. But we've got 3 very successful, very wealthy investors, track records over multiple decades. Obviously, we can go on with many other examples, following 3 different strategies. And so there are many ways to skin this cat. This is how I think of a successful investment strategy. So in order for a strategy to be successful for you, in order for you to have, or basically a framework for you to think about which strategy you should pursue, I think of 3 aspects that would make it successful to you. The first one is obviously needs to make money. So obviously, if there's a strategy that doesn't make money, like coin flipping, for example, then it won't work as a strategy for you. So that's easy. That's the easy part. The second part is the strategy actually implementable? And some strategies work on paper, but do fail. In this case, I have trading costs and scale issues as reasons why some strategies could work. So they may fail in real life. A lot of micro-cap strategies are like that. The bid-ask spreads are just too wide, or the cost of trading is too big. And once actually implemented in real life, they're not so great. And the other part is, again, same example with some micro and small cap strategies, that they're not scalable. So they may be strategies that work for your personal portfolio, but they may not be something worth pursuing as a career because you just can't deploy enough money into those strategies. And even for you, at some point, if you're successful enough following those strategies, you find yourself stuck without a strategy down the line because they just don't scale well. And there are a lot of examples like that. It's just not only in investing in public markets, but in other businesses and opportunities. And then the part that I want to focus on now is that whether the strategy is implementable by you. And I think this part is the part that's often ignored. And there are many reasons why there could be a strategy that is successful in the market, is successful in theory, successful in the market, but you may not be able to successfully execute it as an individual. And I've put up 4 reasons here why I think strategies that could be successful for someone else may not be successful for you, but they're just 4 examples. There are probably more reasons. So, for example, Soros and Simons, if I wanted to follow in their footsteps and follow their strategy, I think I'd fail because I don't think I have the skills or the tools to copy them. So I don't think I have the macroeconomic understanding that Soros has, so I don't have the skill to follow his strategy. And I don't think I have the tools in terms of technology and a bunch of rocket scientists sitting with me developing algorithms that Simons has in implementing his strategy. So without these 2, I'd fail in copying them. And the other 2 that I think are very important are the psychology and enjoyment. The psychology part is very interesting because I'm of the belief that a big chunk of basically inefficiencies that can be exploited by active investors and generate alpha in the market have a very big component of them due to inefficiencies that are driven by behavioral biases. And so your psychology has to fit the strategy that you follow in the sense that it has to work in a way that overcomes those biases in the situations that you're going to be exploiting. Otherwise, if you're exposed to the same biases and you're not doing anything else different versus the person sitting across you on the other side of the trade, this strategy will fail. Value investing, for example, is one of the things that you need to be successful in value investing is to have somewhat of a contrarian streak. So that's one psychological aspect that I think applies to value investing. Some strategies require very active trading on a daily basis, hourly basis, things like that. And you may not have the psychology for that type of strategy. You may prefer to sit around and read and understand things. And so I think the fit between your psychology and the strategy that you pick is extremely important. And the last part that I have here is that the strategy also has to be enjoyable. And the reason I say the strategy has to be enjoyable is twofold. One, most strategies will require a lot of work on an ongoing basis in terms of improvement for 2 reasons. One, the market eventually catches up to the first thing that you discovered worked. So you have to continuously improve, continuously find new things that work within that strategy. And unless you enjoy it, you're not going to want to invest that R&D basically in developing the strategy on an ongoing basis. The other reason I think enjoyable is important for implementing successful investment strategy is that life is just too short. And you should not sit around every day of your life doing something that you hate. And by the way, work is the largest component of your day. So I think that in and of itself is a worthy reason. So what strategy is better? The strategy that fits you. So think of that framework and try to see which strategies fit. And for me, I got very lucky in that I got exposed to value investing very early on, and it just clicked, and it turned out to fit all these boxes. But I didn't think about it in those terms at the time. But I think it's okay if you don't find the strategy that works on day one. It doesn't have to be something that you wake up one day and it's something that you think is the best, the most amazing thing that ever happened to you. And I think exploration and trying to play around and talk to people and then just experiment with things is a good way of learning more about yourself and what works for you. And if you find yourself in a position where it's not working, then really one of these things may be an issue, the skill, the psychology, the enjoyment, and that's a signal. Listen to yourself and make a change if it doesn't work. Now, I'm going to tell you about my journey and how I ended up doing what I'm doing. Then hopefully we'll have some time for Q&A in the end. So this is a bookstore called the Harvard Bookstore. It's in Cambridge, Massachusetts. It's right outside Harvard Yard. And one day in the year 2000, I was walking with a friend of mine, and he had just taken a course with Merrill Lynch over the summer and on investing and stocks and things like that. And he was telling me about investing. He mentioned this guy that he heard about called Warren Buffett, and that he's cool, and I should look him up and find the book. So I went to the Harvard Bookstore based on his recommendation. At the time, I was an engineering student at MIT. I knew a thing or two about investing because I was interested in banking and finance, but I didn't know enough. So I walked in and I bought 4 books. And those are the 4 books that I bought. One Up on Wall Street by Peter Lynch, who at the time had only recently retired from running Magellan at Fidelity, has one of the best track record in the mutual fund industry, the Warren Buffett way. And then the two other books are Technical Analysis and Day Trade Online. And it was the year 2000, so everybody was day trading online. I never read the last 2 books. And I look back and think, and I don't remember if it was just luck or what, but it was probably a little bit of, if not all luck, that I picked the first 2 and read them. And once I read the first 2, I read One Up on Wall Street first and then the Warren Buffett way, and something just clicked, and I felt that it spoke to me. I felt that this is something that I could really do. And I never picked up the other 2 books. I've actually never read the 2 books. I still have them in my office, and I keep them there to remind myself about the role of luck. But someone else could have picked them up and done just fine. I think that's, well, maybe not the Day Trade Online, but. So that's what happened to me, and I started reading about value investing and everything that I could get my hands on. And I think something very important is, obviously you know that reading is important, but I think reading about the experiences of others can help you shorten the journey in trying to find the strategy that's going to work for you. So, again, back to the framework, trying to see why this framework is one that's going to work for me. So, generates return. Well, there's good evidence that value investing over long investment horizons generates excess returns. So that box can be ticked. Trading costs and at scale. Again, the strategy has been practiced by people like Warren Buffett and others, and we know that it works less at scale than it does at small scales. But the market is big enough for many value investing strategies to work even with bigger amounts of money. And is it implementable by you? I don't know if I had, no, I take that back. I knew I didn't have the skills at the time. But I felt that with some work I could acquire the skills. The tools for value investing are luckily readily available and cheap. So I didn't need any supercomputer or anything like that. The psychology, I think, is the one that appealed to me when I first exposed to it. I think I like to think of myself as fiscally disciplined, which is a nice way of saying I'm cheap. So value investing clicked with my personality. I'm always looking for a bargain, trying to buy things at a discount, and I find that a lot of value investors are like that. What they do in their everyday lives is comparable to what they do in their investing lives, and at least the successful ones that I know. I think that's a personality aspect that appealed to me and makes it even more enjoyable, because a lot of the bargain hunting has to do with the high that you get from finding something cheap and selling below what you think it should be selling for. Now, over the years, I think I thought a lot about are sources of outperformance. And I mentioned earlier that I think value investing, a lot of the reasons why value investing is successful have to do with behavioral and cognitive biases. And when I was starting out, and I was 18 or 19, I thought I was going to be successful in value investing because I'm smarter. But yeah, there are a lot of smart people out there. So smarter cannot be your edge. And working harder also cannot be your edge, because people work really, really hard in this industry. So you have to identify, I think, for yourselves, what is it that makes your strategy implementable and successful. And so looking back, I think there are 3 things that worked for us. Now, there are probably many other things that I don't know about. But the 3 things that worked for us over the years is time horizon. I think some people have called value investing a time horizon arbitrage opportunity. But basically, there's a shrinking amount of horizon that the average individual in the market has today. I mean, if you go back in here in the US, for example, back in the 50s, the average holding period was 20 years. Can you imagine? But even as late as the 80s, the average investor held on to shares on the New York Stock Exchange, where this data is from, for 5 years. And now, I think the average holding is less than 6 months. So there's a big shrinking investment horizon out there. And if you have, not always, but if you have a longer horizon, there are many situations where that gives you an edge, in that there is a lot of uncertainty in the short term about what's going to happen, but a lot less uncertainty over a 3 or 5 or 10 year period. And so essentially, by positioning yourself to have a longer horizon and accept that uncertainty, you are getting paid by Mr. Market, by the market, for that thing that is not important to you, but it is important to the average investor. So that's one thing that I think has been very useful for us. The other thing is behavioral biases. We now know through the work of many people about the impact of behavioral biases on investing and on financial decisions in general. And I think there are many situations where behavioral biases drive investors to behave irrationally. And if you can position yourself through the use of tools, and I'll talk a little bit about this, to overcome these biases, or if you have a psychological edge in your personality where those biases impact you differently. They will impact you. Nobody, unless you're Spock, but they will impact you. But other than that, you need to have something that gets you to behave in your behavioral biases differently than everybody else. And then the last thing is what I call the deterministic worldview. And that's the idea that most investors think of discrete outcomes. So they think the stock is trading at 15, I think it's worth 20, it's going to go up by 33%. And we like to think of things more probabilistically. And so think of 2 scenarios, 3 scenarios, 4 scenarios, 5 scenarios, take it to the extreme, and think of 1,000,000 scenarios. And think of plotting all these scenarios around that core value, and try to think about things in that way. So think of many, many, many potential outcomes. And in many cases, that doesn't matter. But there are cases where that shape, the shape of the curve, is very informative and can be skewed one way or another. And in those skewed situations, you can exploit the opportunity to make money at lower risk than average. So those are the 3 things: time horizon, behavioral biases, and deterministic worldview. And this is how we've dealt with them. Again, this is our strategy exploiting it, but I'm sure there are other ways of exploiting those inefficiencies under different strategies. So the first one is the time horizon. That's the easy one. You need to have a longer horizon. How do you do it? Well, ignore short-term questions. People find this really hard, but I believe that that's the only way. If you try to say, I want to do well in the short term and in the long term, you'll fail. So you have to handicap yourself. You have to basically put yourself at what looks like a disadvantage by refusing to think about the short term. And that gives you a clearer mind to think about the long term. The second thing is a longer holding period, and that's something that you have to, again, build over time until it becomes an expectation for you. If you're managing money for others especially, that's very important because that drives their expectations, which psychologically impacts you. So once you become a fund manager that's known to have a holding period of 5 years or 6 years or 7 years, you will find that psychologically you as an investor, when you're trying to make a decision that involves a 6-month or 1 year horizon, you kind of feel something wrong because that external image of people about who your identity is, what your identity is, it starts to impact you and influence your decision, in this case in a positive way. So basically, in a sense, you're faking it until you make it, right? And the last one is selecting like-minded investors. And I think this is really hard, if you're managing money for others, especially in today's world. Because you're also running a business, right? And you want to grow and you want to make money. But I think there's a balance that you need to find. And there are many situations, especially people who end up with controlling investors, so investors who own a big chunk of their fund but have a very different perspective in terms of time horizon, where that's been the reason why they fail. And they can be silent. That's not the issue. The issue isn't that they're silent. If you know at the back of your head that their expectations are such that you have to make the money every quarter, every year, you will be biased. You will not be able to think long term if you know that the investor base is that type. The second thing is behavioral biases. Now, I think the first step in overcoming behavioral biases is admitting that no one is immune to them and trying to say, oh, well, no, I'm not going to be impacted by that. That's the first step towards failure. Everybody is impacted by behavioral biases. And the only way that we now know to work, not perfectly, but it can help, is to use tools. And so, for example, what we do when we're looking at an investment idea in our process, the first thing we do is something we call trying to kill the idea quickly. And this was born out of necessity for a while. So when I first started doing that for many years, I worked by myself and I didn't have the time to invest in researching every idea. And so for many years, I developed this habit of trying to say no, basically, as soon as possible. And not invest a lot of time in an idea and then discovering that it's not going to build up to something. But then over time, I discovered that starting by your process by looking at what you don't like, looking for things that are ugly, that are bad, things that you hate, puts you in a frame of mind psychologically where it overcomes something that's known as confirmation bias. So confirmation bias is you look at something, you like it, you start trying to find the evidence that supports your first impression, basically. And eventually, you will find the data that supports reasons to buy, for example. But if you're a long-only investor, for example, and you start by using short sellers tools, looking for the things that could cause this investment to tank, then you reduce the effect of confirmation bias because you start by looking for all the reasons why you hate an idea, things that you probably will not do if you started looking at the things that you like. The second thing that we do is a checklist. And checklists are known. There's an excellent book called The Checklist Manifesto on the subject, a few others. But checklists are known as a very good tool to help deal with behavioral biases. And they've been shown for a very long time to work in aviation, but more recently they've been used in medicine, in ERs, and in other applications where they help us as human beings overcome our behavioral biases. One example of that we have, that's part of the checklist, but I have it as separately, something called the internal rules. So we have, I list a couple of rules here, things that are automatic decisions, basically, things that we will do without thinking if A, B, and C are satisfied. And one of them is called the broken thesis rule. Another rule is, so the broken thesis rule is when we buy something, we write in 3 lines why we bought that stock, for example. And we review that every quarter when the company reports. And they have to be concrete and measurable, and they have to have a deadline. And if one of them fails, then we place the stock on basically an alert. And if 2 of them fail, then we sell the stock immediately, no matter what. In fact, if 2 of them fail, we have a rule within 48 hours. If, for example, I'm not in, my assistant portfolio manager sells the position if he can't get a hold of me within 48 hours. Now, and the idea is basically we can always come back and buy the stock, but we don't want to be in a position where the stock comes down and you're trying to find reasons why you want to continue to hold. Another one that's linked to it is the add 1% or sell rule. And that's the rule, again, that we have where when we buy, we put limits on as part of our thesis of when we have to make a decision to either add 1% of our portfolio to that position or sell out completely. And that we think helps with loss aversion. So loss aversion is is another behavioral bias that we have as human beings, which is basically you buy a stock for 15, goes down to 10, you tell yourself, as soon as it goes back to 15, I'm selling. And the reason that this is silly is that the stock doesn't know what you paid for it. And so there's no reason why it should go back to 15. And the most important question isn't what happened from 15 down to 10, but what's going to happen after 10. So is this stock from 10 to 15, in order for it to go from 10 to 15, you needed to go up by 50%. Is this stock going to go up by 50%? Is it going to do better than every other investment opportunity out there? Forget about what happened in the past. And if it is more likely to do well, then we should be able to add 100 basis points, 1% of the portfolio to that position. If we are uncomfortable and not confident enough to add a mere 1% to the position, then that means we think we are falling to a victim to loss aversion, and it's time to sell the position completely. So that's another rule that we did to deal with our behavioral biases. And the third thing is the deterministic worldview. I mentioned that simulation. So basically think of, you could do it in scenario analysis, you could do it using Monte Carlo simulations. It doesn't really matter. What matters is you expand the range of outcomes in your head. And by exposing yourself to these outcomes very early on before you make a decision to buy something, I believe that it puts you in a better position to exploit skewed outcomes. And there are a lot of them out there that you can exploit from time to time. Most investment opportunities that do work out because they're skewed, where the odds to return ratio is messed up. And I think simulating or doing scenario analysis can show you that that's the case. And the third one is intellectual humbleness. So my colleague Aubrey came up with this term, Occam's investment. There was Occam's razor. And basically, the principle goes like this. The investment that requires the least number of assumptions is likely to be the best one. And the reason that's the case is that if you say that I can get any assumption correct 80% of the time. So anytime I look at an assumption about the future, I'm going to be right 80% of the time. And that's a very high success rate. But let's say that's the case. Let's say you're really good and you think you're going to be right 80% of the time. Well, every time you add an assumption, the second assumption is also 80% of the time. Multiply it by the first, multiply it by the third, the fourth. By the time you get to 4 assumptions, you're down to 40%. By the time you get to 10 assumptions, you're down to approximately 10%. So every assumption that you add reduces the odds that you're going to be correct. And so in order to increase the odds, you basically, if you look at it, basically you're talking about 3 assumptions. Anything below 3 assumptions in this case, you're already flipping a coin. And so have the intellectual humbleness to know that you're not going to be able to predict all these variables in your fancy Excel model for the next 10 years. And I'll leave you with this quote from Guy Spear, who I believe is going to be coming here at some point to speak. Great guy. And Guy, in his book, The Education of a Value Investor, I think is an excellent book to read. And he says, instead of trying to compete with Buffett, I should focus on the real opportunity, which is to become the best version of Guy Spear that I can be. Thank you.